Hello and welcome to the second in Kinetic Training series of bank risk videos. I'm afraid to tell you, dear viewer, a terrible crime has been committed, a murder no less. We need your help to find out who killed risk management. The extreme losses witnessed by the banking sector in 2007-2008 suggest that the risk management tools in use were not just incorrect but positively misleading. Let's check our prime suspects. This is Fisher Black and Myron Scholes, famous for developing the Black-Scholes option pricing model, which is a method of pricing certain derivatives trades, and it's been taken up by the industry and been in use now for probably over 30 years as a standard way of measuring risk. These guys became very famous, so much so that in 1997 they won the Nobel Prize for Economics. And the committee mentioned their method has facilitated more efficient risk management in society. Well, that's probably not something that gets said too often these days. In fact, this whole technique of using maths and statistics to measure your risk, and indeed everything that's been taught in business schools, that all has their own set of critics. For example, just put them to shame, ignore them, put them down, discredit business schools, ask for cuts in funding. Well, not one to mince his words is Mr. Taleb. Nassim Taleb has written two wonderful books on risk management, which I'd urge you all to read, Fooled by Randomness and The Black Swan. They're really very easy to read, no equations in there, and such a deep understanding of risk. It's really wonderful, insightful writing. Okay, but what exactly is their crime? Well, let's check out the murder weapon. This is a normal distribution, so-called because it occurs so frequently. It occurs all over the place in nature, in fact. I was going to use some example of monkeys, but then I realised I don't really know much about monkeys, and they probably don't have much to do with banks anyway. I suppose they do live in trees, so maybe a few of them are branch managers. But anyway, that's by the by. This normal distribution occurs a lot in nature. For example, if you measured the height of all the adult males in the UK and you plotted the frequency, you'd get something like this, with people around 5'10" to 6 foot tall. In the middle hump here, very probable you meet someone that height. But then as you get higher and higher, 6'5", 6'6", or indeed lower and lower, 5'5", 5'4", then this hill sort of drifts off and gets much lower probability of meeting anyone of that height. Because this has such nice mathematical properties, this normal distribution has been used a lot, including the Black-Scholes pricing method, in finance. And VAR, or value at risk, is a common measure that you often hear about, and that is really looking at, in the tail of this distribution, what is the worst possible events that could happen. Well, during the recent crisis, we had 20 sigma events, which is just a mathematician's way of saying it's 20 steps away from what you'd expect happening. Well, what does that really mean? Well, the probability of a 20 sigma event, if you're using a normal distribution, is 0.000000000, oh goodness, it's a bit quick, 0001. Yep, there you go, quite a lot of zeros, has to be said. To get a more practical view on that, let's ask our friends at Goldman Sachs. 20 sigma is 10 times the number of all particles in the known universe. 25 sigma, and we experience some of those events as well, is equivalent to winning the National Lottery 21 times in a row. Well, it is clear that if you have a risk model that is giving you those kind of probabilities, and then these things actually happen, the risk model is not just wrong, it is positively misleading and dangerous. Let's look at an actual example. If you were given this set of data between 2004 and 2007, and you were asked to model it, well, being a mathematician, I'd tell you, well, the average is probably about 15. Volatility, or sigma if you prefer, is maybe plus or minus 4 or 5, something like that. And you'd expect that to just keep trundling along. Of course, what actually did happen sudden explosion, jump up to this 80 level. Again, it's about a 20 sigma event, almost impossible if you believe the normal distribution. And I chose equity volatility here, but equally well you could have chosen many variables that we witnessed: stock prices, Lehman share price, obviously that would be going down rather than up, any amount of credit spreads. You could look at the Greek government credit spreads at the moment. You'll see similar very extreme wild events that you wouldn't expect, wouldn't possibly predict from the historic data. Well, it's easy to criticise, and indeed it's fun too, but what else can we do? We need to get some handle on risk. Well, maybe another possibility, and I think this will become a lot more important, certainly the regulators are starting to look at this a lot more, is stress tests. So throw away all your statistics and just define one possible future scenario for the world. So for example, you say, okay, what happens if interest rates remain at 0.5% for the next 10 years? What's going to happen to me then? Well, the probability of that happening might be another 20 sigma event if you're doing it statistically, but it doesn't stop you asking the question. And then if you look at how the bank would perform under that particular scenario, that could give you some insight into the risks that the bank is running. The only problem with it is how do you decide what the stress test is? I mean, you could just make up anything. And that's why I think one method that may become more and more popular over the next few years, I think both through the regulators and also banks internally, are reverse stress tests. Now this is the same idea. You choose one scenario, but you start from the end. What do I mean by that? Well, you look at your bank and you say, suppose the bank went bust. What possible scenario could have caused such an event? And then you work backwards and see what you'd have to put into the model in order to get the company to go bust. And I think if Lehman Brothers had run some reverse stress tests in 2005, 2006, certainly one of the things that would have come out of it would be a subprime mortgage price collapse. And so that would have given some important information that was perhaps lost because we're using the statistical approach. Well, there's the evidence. But what's your verdict? Should we throw away all the stats? Keep them but use stress tests more? Or maybe there's other ways to do it. Intuition. Gut feel? I don't know. I'll leave that for you, the jury, to decide. Thank you for watching this video from Kinetic Training. Please join us at our website, kinetictraining.co.uk, and I hope to speak to you soon. Bye bye.